More than half of American homes lost value last year. Not in the news, not in the headlines, buried in the data. The national average says prices are flat, stable, maybe even nudging up a little. The media is telling you the housing market is resetting, healing, finding its footing. They are not lying to you with fiction. They are lying to you with math. And the algorithm sees it. Because the data was there in 1929 too. By the end of this video, we will show you exactly what the data is saying. Not what the banks want you to hear. Not what the real estate industry needs you to believe. What the numbers actually show. And once you see it, you cannot unsee it.
Let us start with the oldest trick in the statistical playbook. Imagine 10 people in a room. 9 of them just lost money. 1 of them made a fortune. The average? Everyone broke even. That is the American housing market in the current cycle. Zillow published a report. It found that 53% of homes across the United States declined in value over a 12-month period. The average loss from peak value? Nearly 10%. But the national median price index? Almost flat. How is that possible? Because a handful of resilient, expensive coastal markets are dragging the average up. While underneath the surface, in the Sun Belt, in the starter cities, in the places where millions of first-generation homeowners bought their piece of the American dream at the very top of the market. The erosion is already happening. This is not a crash. Not yet. This is something more insidious. A slow bleed. A grinding loss that does not trigger alarms, does not generate headlines, and does not show up cleanly in the statistics that make the evening news. The US Treasury Secretary called it what it is. He used the words, housing recession. Not a commentator, not a skeptic. The sitting Treasury Secretary of the United States. That is the contradiction at the center of this story. Official spokespeople are still saying the economy is in good shape, while the data underneath is telling a completely different story. The algorithm has seen this contradiction before. The year was 1929. Here is what the mainstream narrative is not telling you. The National Price Index is a weapon. It is used to create the appearance of stability. In January of this year, existing home sales in the United States collapsed 8.4% in a single month. That is the sharpest monthly drop in nearly 4 years. It brought annualized sales to 3.91 million units, a pace not seen in over 2 years. Sales volume is the heartbeat of the housing market. When it drops this fast, this is not a healthy market taking a breath. This is a market freezing. Now add the hidden costs, the ones nobody puts in the calculator when they tell you homeownership is, quote, the best investment. Property taxes. In cities like Atlanta, Jacksonville, Tampa, Orlando, Dallas, and Denver, median property tax bills rose between 45% and 65% since 2019. That is a 3-digit monthly increase, silently draining homeowner cash flow. Then there is insurance. Nationwide, home insurance premiums have risen 70% since 2021. If inflation is the silent killer, insurance is the slow poison nobody warned you about. Now layer on debt. More than 2/3 of new FHA loan recipients today carry a debt-to-income ratio above 45%. The industry threshold for, quote, risky, the same threshold that regulators flagged before the 2008 crisis. And the foreclosure clock is already ticking in specific markets. Houston, Orlando, Jacksonville, Miami, Dallas, Atlanta, Tampa. These are the cities analysts are watching. The same geography that saw the highest foreclosure rates during the last crash. But here's the critical difference. And this is where the 1929 parallel becomes sharp. In 2008, the weapon was the adjustable rate mortgage. Rates reset, payments exploded, foreclosures flooded in. This time, the trigger is different. Reassessment crisis meets climate crisis. Property taxes are being recalculated based on pandemic-era valuations, valuations that are no longer real. Homeowners are receiving tax bills based on a home worth $450,000 in 2021. That same home may now be worth $390,000, but the government still wants 2021 prices. And then the insurance industry. In high-risk climate zones across Florida, Texas, and the Gulf Coast, insurers are pulling out entirely. Homeowners cannot get coverage. And a home you cannot insure is a home you cannot sell.
And a home you cannot sell is a liability, not an asset. Now scan back to 1929. The data remembers. In the years before the Great Depression, Americans were told that real estate was the safest investment, that prices only go up, that national averages were healthy. Economists who studied the Smoot-Hawley era found a consistent pattern. The warning signs were granular, localized, and suppressed in aggregate statistics. The broad index looked stable. The local reality was collapsing. We are watching the same film again. New technology, new framing, but the same structural decay hidden behind the same statistical illusions. Redfin calls what is happening now the Great Housing Reset, a polite name for a prolonged period of stagnation, where the only thing that is guaranteed is time. 5 years, they say, before the market returns to anything resembling normal. 5 years. For millions of Americans who bought at peak valuations with peak mortgage rates, that is 5 years of being locked in. Negative real returns, high carrying costs, in a home they cannot afford to sell and cannot afford to keep. The algorithm calls this a trap. So what does the data actually say? First, the National Price Index is not the signal. The signal is in transaction volume. When sales volumes collapse and inventory begins to rise, price is always the lagging indicator. In plain language, price does not fall first. Volume falls first. We are watching volume fall. Second, the risk is concentrated, not systemic. This is not 2008 with contagion baked into derivative instruments held by global banks. The danger zone is specific. Sunbelt starter cities, high-tax metros, climate-exposed coastal markets, high FHA loan concentration neighborhoods. In our research portfolio, we are watching these markets very closely, not with alarm, but with discipline. The data says a specific geography is under acute stress, while other markets with constrained supply and higher income floors remain relatively insulated. Third, the escape valve that politicians are reaching for is more debt dressed as innovation. Longer amortization mortgages, 40-year loans, fintech-linked underwriting, crypto-collateralized products. These are not solutions. They are a monthly payment illusion. They lower the payment, they extend the obligation, and they push the reckoning further down the road. The 1929 detective file has a note on this. When the financial system cannot fix the price, it lowers the payment, until it cannot. In our own analysis, we are not predicting a 2008-style cliff. The structural buffers are real. More than half of current mortgage holders locked in rates below 4%. The equity cushion for that cohort is deep. A mass foreclosure event is not what the data is pointing to. What the data is pointing to is something quieter, and in some ways, worse. A decade of stagnation. A generation of wealth transfer frozen. An entire class of buyers who entered the market between 2020 and 2023, now facing a decade-long sentence of break-even returns, rising taxes, rising insurance, and an asset they cannot liquidate without taking a loss. The data does not lie. It just takes time to speak at a volume loud enough for everyone to hear. Here's the question we are sitting with in our own research. If a market is technically not crashing, but delivering a decade of zero real returns while bleeding you through taxes, insurance, and debt service, is that not a crash in slow motion? The 1929 case file would say yes. The speed is different. The structure is the same. We are continuing to track transaction volume, FHA delinquency rates, insurance market withdrawals, and property tax reassessment cycles as our core forward indicators, not price. Price is the last signal. These 4 metrics are the first. Before we go, we want to ask you one question, and we want the honest answer in the comments. If you own a home right now, has your property tax or insurance bill increased significantly in the last 2 years? Tell us below, because your answer is data, and data does not lie. If this analysis gave you a perspective the mainstream is not offering, subscribe to this channel. This is what we do, every single week. And we have launched our exclusive newsletter for daily market analysis and deep decoding. Gain your free access today to join our inner circle. Link in the description. The data is speaking. The question is whether you are listening.